is currently a small company trading near the $3 level that has lost roughly two-thirds of its value since its October highs. At first glance, the argument being presented is that this decline represents a disconnect between market price and business progress. But serious investors should approach that conclusion with caution, because sharp price declines in small-cap defense technology firms rarely occur without structural reasons. Yes, the company has spent the past year expanding contracts, strengthening infrastructure, and positioning itself within the artificial intelligence defense ecosystem. Those developments sound promising in isolation. However, markets do not price companies based on activity. They price them based on execution reliability, scalability, and confidence in future cash flow durability. And that distinction matters. The claim that price and progress often diverge in the short term is technically correct. But what is frequently ignored is that markets also tend to anticipate execution risk earlier than retail investors recognize it. When a stock declines by more than 60% within a matter of months, the burden of proof shifts away from optimism and toward explanation. In other words, the market may not be misunderstanding the company. It may be discounting the probability that projected growth converts into sustained profitability. Supporters of the bullish narrative often point to geopolitical tension, particularly involving the United States and Iran, as a source of temporary investor anxiety. The suggestion is that headlines, rather than fundamentals, are driving valuation compression. That explanation sounds reasonable on the surface, but historically it has rarely been the dominant factor affecting small-cap defense technology equities. Large institutional investors do not typically exit positions because of headlines alone. They exit when uncertainty intersects with limited balance sheet resilience, narrow contract concentration, or execution ambiguity. And those risks exist here. Another common argument is that uncertainty is always present in markets, and therefore falling prices simply reflect exaggerated fear rather than deteriorating fundamentals. While it is true that uncertainty never disappears, it is equally true that uncertainty is not priced evenly across companies. Businesses with proven margins and stable contract pipelines absorb uncertainty differently than emerging AI contractors still attempting to establish scale credibility. Lower prices are often framed as improving the long-term risk-reward profile for patient investors. But patience alone does not create returns. Patience must be paired with accurate thesis selection. Buying during pessimistic sentiment can produce exceptional outcomes, or it can lead to long periods of capital stagnation if the pessimism turns out to be justified. This is exactly why disciplined investors focus less on narrative timing and more on structural positioning. The idea that investors panic during downturns and sell prematurely is frequently repeated in market commentary. However, what is rarely discussed is that professional capital managers often reduce exposure not out of fear, but out of portfolio optimization logic. When opportunity cost rises elsewhere in the market, smaller speculative positions are usually the first to be reallocated. That behavior is not emotional. It is rational capital rotation. Trying to predict turning points based on geopolitical developments, interest rate expectations, or defense budget headlines is inherently unreliable. But what can be evaluated objectively is whether a company's valuation reflects realistic expectations about its ability to compete within a rapidly consolidating defense AI landscape. And this is where the conversation becomes more complicated than the bullish thesis suggests. The company operates in the decision intelligence segment of artificial intelligence, transforming satellite imagery, sensor feeds, logistics data, and biometric inputs into operational insights for government clients. That positioning is strategically relevant. However, relevance does not automatically translate into dominance, nor does it guarantee long-term contract defensibility in a sector increasingly influenced by major defense primes and hyperscale technology firms entering classified environment AI deployment. Investors should therefore be cautious about assuming that participation in a strategic sector automatically ensures participation in its long-term value creation cycle. In emerging defense AI markets, capability matters, but scale, integration depth, and procurement relationships matter even more. And those are variables the market may already be evaluating more critically than the current bullish narrative acknowledges. A central pillar supporting the bullish narrative around this company is the rapid expansion of artificial intelligence spending within the United States defense ecosystem. It is true that for the first time, the Department of Defense has introduced a dedicated budget allocation for artificial intelligence and autonomous systems exceeding $13 billion for fiscal year 2026. At first glance, that number appears transformative. But investors should be careful not to confuse sector expansion with company-level inevitability. History shows that when new strategic spending categories emerge inside the defense budget, the majority of that capital does not flow evenly across the contractor landscape. Instead, it tends to consolidate around prime integrators, trusted platform providers, and firms already embedded deeply inside classified operational frameworks. Smaller specialized vendors often participate, but rarely dominate. This distinction matters because the investment case being presented relies heavily on the assumption that structural defense AI growth will automatically translate into proportional opportunity capture. That assumption deserves scrutiny. Government procurement does not operate like commercial software adoption cycles. Contracts are influenced by compliance history, integration compatibility, security clearances, political continuity, and multi-agency alignment. Even technically capable firms can struggle to convert pilot deployments into recurring program of record contracts. Supporters of the company frequently point to leadership experience within federal institutions as evidence of a competitive advantage in navigating procurement channels. While institutional familiarity is valuable, it is not a substitute for scale credibility. Decision-makers inside defense agencies prioritize execution certainty above narrative alignment, particularly when projects involve mission-critical intelligence workflows. Experience opens doors, execution keeps them open. Another commonly cited strength is the company's presence inside operational environments such as biometric identity processing across major U.S. airports and its deployment of secure artificial intelligence platforms inside classified infrastructure. These achievements are meaningful signals of capability, but they should not automatically be interpreted as guarantees of long-term contract durability. Deployment access is not the same thing as contract permanence. Government technology stacks evolve continuously, and agencies frequently rotate vendors when integration strategies shift or when broader modernization initiatives favor platform consolidation under fewer providers. Investors must therefore ask a more difficult question. Is the company positioned as a long-term infrastructure layer inside the defense AI ecosystem, or as a specialized contributor operating within a competitive vendor rotation cycle? The answer to that question determines valuation sustainability. Recent acquisitions expanding capability into cargo inspection and threat detection technologies are also being framed as strategic positioning aligned with border security and trade monitoring priorities. While this expansion increases the company's addressable market footprint, acquisitions at the small cap level introduce another variable investors cannot ignore: integration risk. Combining technologies across multiple operational domains requires both capital discipline and execution consistency. Without those elements, acquisitions can expand narrative scope faster than they expand revenue reliability. Another frequently highlighted metric supporting the bullish thesis is the company's backlog, which reportedly exceeds 3 times recent annual revenue. Backlog visibility is certainly helpful when evaluating forward revenue confidence. However, backlog alone should never be interpreted as guaranteed realization. Defense backlogs represent potential future revenue, not secured profitability. Contract timing adjustments, budget reprioritization cycles, and scope revisions regularly affect realization schedules. In smaller contractors especially, backlog concentration risk can create volatility if even one major program shifts timeline expectations. The company has also strengthened its balance sheet through capital raises that increased cash reserves while reducing debt exposure. Optimistic interpretations describe this as strategic positioning for long-term growth investment. But capital raises in early-stage defense technology firms almost always carry a second interpretation that investors must acknowledge. They reflect financing necessity as much as strategic ambition. Dilution is acceptable when it accelerates durable revenue expansion. It becomes problematic when it simply extends operational runway without materially improving contract conversion velocity. This is why balance sheet improvement alone should not be treated as evidence of strengthening competitive position. It should be treated as preparation for a longer execution timeline than originally expected. Another argument frequently presented in support of the bullish interpretation is that the company trades at a significantly lower valuation multiple compared to larger firms operating in the broader defense and artificial intelligence sector. On the surface, this appears to create a compelling opportunity. But valuation discounts rarely exist without structural justification. Smaller defense technology companies typically trade at lower revenue multiples for reasons that extend beyond simple market oversight. Investors apply discounts to reflect scale limitations, contract concentration exposure, integration uncertainty, and execution risk across longer procurement timelines. These factors are not temporary distortions. They are embedded characteristics of the segment. In other words, the discount itself is often part of the risk profile rather than evidence of mispricing. Comparisons with larger peers can therefore become misleading if they ignore differences in operational maturity. Prime defense contractors benefit from decades of procurement relationships, multi-layer integration authority inside classified environments, and predictable renewal cycles tied to long-term program infrastructure. Emerging AI-focused contractors operate under a very different reliability framework. They must continuously prove capability rather than rely on historical positioning. Supporters of the optimistic case often suggest that if the company continues executing successfully, a revaluation toward peer-level multiples could occur. While that scenario is possible, it assumes that execution progress translates directly into procurement permanence. In practice, the relationship between capability growth and valuation expansion is rarely linear. Markets typically wait for contract stability before adjusting multiples upward. Another assumption embedded in the bullish thesis is that the current share price reflects a scenario in which very little of the company's future opportunity materializes. This interpretation suggests that downside expectations are already fully priced into the stock, but that conclusion may be premature. When investors discount future outcomes aggressively, they are often responding not only to company-specific risks, but also to sector-wide competitive pressure. Artificial intelligence within national security infrastructure is rapidly becoming one of the most strategically contested technological environments in the global defense economy. Large cloud providers, traditional defense primes, and specialized analytics platforms are all moving into the same operational territory. Competition in this environment does not remain static. It accelerates. That acceleration changes the probability distribution of future outcomes. Instead of evaluating whether a company participates in sector growth, investors must evaluate whether it captures a meaningful share of that growth relative to increasingly powerful competitors entering the same procurement channels. Even optimistic projections therefore require careful qualification. Yes, demand for AI-driven decision intelligence tools is expanding. Yes, defense agencies are increasing reliance on automated data interpretation across satellite imagery, logistics tracking, and biometric processing systems. And yes, geopolitical competition between major powers continues to reinforce the strategic importance of these capabilities. But demand expansion alone does not determine contract allocation. Execution depth determines allocation. It is also important to recognize that market participants frequently anticipate structural transitions before they become visible in reported financial statements. When a stock declines sharply despite improving capability announcements, investors are often reacting to expectations about timing rather than direction. Timing risk can be just as influential as technological positioning. If revenue realization occurs later than anticipated, valuation compression can persist even while long-term opportunity remains intact. That dynamic creates extended periods in which a company appears fundamentally promising yet continues trading below optimistic projections. This is not market irrationality, it is market sequencing. Supporters of the bullish interpretation often broaden the argument beyond the company itself by pointing to larger structural transitions taking place across infrastructure, energy systems, aviation fuel supply chains, and national security logistics modernization. The suggestion is that early-stage companies operating near these transition zones frequently appear undervalued before their strategic importance becomes widely recognized. That observation is not incorrect, but it is also not sufficient as an investment thesis. Structural transitions create opportunity at the sector level, not certainty at the company level. History shows that during every major technological shift, whether in cybersecurity, satellite communications, cloud infrastructure, or autonomous systems, only a small number of participants ultimately capture durable long-term value. Many early entrants demonstrate technical relevance without achieving procurement permanence. Participation is not the same as positioning. The aviation fuel transition example illustrates this clearly. Sustainable aviation fuel remains an important long-term objective, yet production capacity constraints, capital requirements, and regulatory alignment challenges continue to delay large-scale adoption timelines. Smaller firms attempting to build capacity in this space face execution hurdles that markets correctly price as uncertainty rather than opportunity certainty. The same logic applies to emerging defense artificial intelligence platforms. Investors should therefore resist the temptation to assume that early alignment with national security modernization themes automatically guarantees future valuation expansion. Strategic relevance increases probability. It does not eliminate execution dependency. Another key argument supporting the optimistic outlook is that the central investment question should not be whether uncertainty exists, but whether uncertainty has already been reflected in the company's current share price. That framing sounds compelling, but it simplifies a much more complex reality. Markets do not price uncertainty once. They price uncertainty continuously. As new competitors enter procurement channels, as contract timelines shift, and as budget priorities evolve across defense agencies, valuation assumptions adjust accordingly. A stock trading at depressed levels is not always signaling excessive pessimism. Sometimes it is signaling unresolved visibility, and visibility matters more than narrative momentum. It is also frequently suggested that when a company strengthens operational capability while its stock price declines, the resulting tension eventually resolves in favor of improving fundamentals. In some cases, that outcome does occur, but markets do not reward capability expansion automatically. They reward confirmed execution, recurring contract stability, and predictable revenue scaling. Until those signals become visible at the financial statement level, valuation recovery tends to remain conditional rather than inevitable. This distinction is essential for disciplined investors. The real analytical challenge is not determining whether the company operates in an important sector. That point is already clear. Artificial intelligence inside national security infrastructure will remain one of the defining technological priorities of the coming decade. The challenge is determining whether this particular company captures enough of that opportunity to justify a re-rating cycle within the competitive landscape it currently faces. That is a much narrower question, and it is the question markets appear to be asking right now. In the end, successful investing in emerging defense AI companies requires more than recognizing thematic alignment with future government spending priorities. It requires identifying which firms convert access into contracts, contracts into scale, and scale into durable profitability. Until that conversion sequence becomes visible with greater clarity, the current valuation discount may reflect caution, not misunderstanding.